from 2001 to 2011, we had the first leg up, and then we had a cyclical correction inside this big secular bull market, the mid-cycle correction, which I think now is over with. And we're going to see gold and silver, especially silver, go to some amazing heights. Happy New Year to everyone, and I wish peace, prosperity, and safety to all of you in this new year, especially safety. I think with what's been happening in the stock markets, that is key. And that safety, I think it's going to be a very, very good year for precious metals investors. I think that safety is going to lead to prosperity, and it's going to happen over the next couple of years, and I'm going to be showing you that in a little while. For the past couple of years, New Year's is when I sort of make some predictions on what I think might happen in the coming years. And for this year, I think that we're finally at this place that I have been preparing for now since 2002. I have been getting ready for what I think is about to come. Just as a reminder, this is a performance comparison between the S&P 500 and gold. And so for this century, from the year 2000 until now, the precious metals have been the best performing asset class other than cryptocurrencies, which came out in 2008 is when Satoshi Nakamoto introduced Bitcoin. And so that's a relatively new event, and there are great percentage gains to be made when you're coming off of zero. But cryptocurrencies right now are down quite a bit. A lot of people are sitting on significant losses if they got into it since Bitcoin peaked in last December. So over the last year, 2018 was a very bad year for cryptocurrencies in general. And so I do own some cryptocurrencies, some that I've got profits on and some that I'm sitting on losses. But when things are down, that's the time to accumulate. But I think precious metals investors are going to have a lot to celebrate in the coming year. So this is the S&P 500, and you can see that it from the year 2000 until 2018, that it pretty much doubled. But on the way there, investors had to take this wild roller coaster ride sitting on these enormous losses. And if you were smart enough to sell your stocks at the peak in 2007 or sell your gold at this peak in 2008 and then buy back into the stock market right at the bottom after the Lehman collapse and the global financial crisis, right at the bottom in 2008, then you would have done better than gold. But you know what? I'm not that smart. I can measure the beginning of a bull market, like the secular bull market that began here in gold. I could tell you that gold was 1/45th of the Dow, that it was extremely undervalued. The gold real estate ratio was extremely out of whack. But right here, PE ratios were insane. I could tell you that the stock market was in a bubble, and I did, and a lot of people did get out of it and get into gold because of me. A lot of people got out of real estate and into gold because of me, and then real estate crashed right after that. But I could tell you that the stock market was in a bubble because of PE ratios and dividend yields and other various ways of measuring its value. But here, this trying to get back into stocks at this bottom here, stocks, the PE ratios had fallen down almost to fair value. They had fallen from bubble territory into the extremely overvalued area, and then they just touched fair value and bounced back off into extremely overvalued and back into a bubble. And today we're once again in hyper-bubble territory with stocks. So what would it look like if you were that smart and you could somehow magically predict that bottom would come right there? Well, you would have done a lot better in stocks than in gold. But the reason I show you this chart, stocks would have given you this great return. First of all, we've got this really ugly top going on here in the stock market, and I think that the top is in. I think that what I have been waiting for and investing toward for the last 15 years is finally here. But what I want to show you is, even though the stock market made these incredible gains during this period of time, gold held its own. It just sort of noodled sideways when it should have been falling. This type of rise in the stock market should have pushed gold below $1,000, and it didn't. And the reason that it didn't, I believe, is because China and Russia have been buying up so much of the world's gold production, getting prepared for whatever is coming. Now, there was a period here where gold and the stock market rose simultaneously, and that is because of the fear that was left over from the 2008 crisis, propelling gold up into its peak in 2011. Now I want to show you gold measured in Australian dollars. Our Aussie friends have something to celebrate. This does not contain intraday information. If it did, you would see gold has been setting all-time historic highs measured in Australian dollars. So this is a function of exchange rates. The reason that gold noodled sideways all of this time is because the dollar was rising. Gold measured in many other currencies is setting all-time highs. Now I want to go back to the stock market and sort of try and predict what may lie ahead in the future for stock market investors. We've got this really ugly sort of double top here, and these pullbacks that happened in 2018, and then the crash after Jerome Powell, chairman of the Fed, announced the last rate increase, that they were going to stick with these rate increases. And basically, he sacrificed the stock market to support bonds and the U.S. dollar. If he had not done the rate increases, then the U.S. dollar and bonds would have started to crater, and the stock market may have kept on going higher. They're stuck in a corner, and they have to make some very tough choices, and it's basically one or the other, and they chose U.S. Treasuries and the dollar over the stock market. So the stock market has made this little crash. Where would it go from here? I mean, just eyeing this thing, you can see a big support zone where there was a whole lot of trading going on in 2015 and 16. In this area, there's a lot of buyers and sellers right in there. And so that's sort of a logical place for it to come down and then bounce. There's also support from this minimum right here, this little dip. Those tend to be support zones. And then there's really nothing in here that becomes support until you get back to the previous highs of the stock market in the year 2000 and 2007, the double top that happened there. But I want you to notice something. It sort of rises and then puts in a double top here, and then when it falls and crashes, it rallies up somewhere into where these previous dips were. And then we've got a double top here, and it crashed, and it rallied up right to where that dip is. Well, I want to introduce you to somebody now. His name is Fibonacci, and in the year 1202, he wrote a very important paper, a math paper, that introduced the Arabic numeral system to Europe. We had been using the Roman numeral system, which makes math incredibly difficult and makes the calculation of interest practically impossible. When Fibonacci introduced the Arabic numeral system 1, 2, 3, 4, 5, 6, 7, 8, 9 to Europe, suddenly banking, finance, and math became much, much easier. But in that same paper, he also introduced something that we now call the Fibonacci sequence. You've probably seen this beautiful pattern before that is created by the Fibonacci sequence. And this occurs all over nature. You see it in the way plants grow. This is a pattern that was created using the Fibonacci sequence. You see it in the nautilus shell. It's just an absolutely beautiful thing that occurs throughout nature. And here's something that I have to introduce here. Humans are a part of nature, and we have herding patterns. Here, gravitational pull is what's causing these spiral arms in a galaxy, and the gravitational pull follows Fibonacci sequence. Now I want to get back to the stock market. And, on stock charts where I generated these charts, there's a tool for introducing what are called Fibonacci retracements. And so this is when you put a Fibonacci retracement on it, those visual things that I picked out as far as areas where the stock market should bounce, the support zones, it just fell right on top of those. And I didn't do this until today. And I was just astounded. I had looked at the stock market first, and I said, well, where is it going to fall to? Where will it make some bounces on the way down? And the first one here is in this big support zone, and then you've got that dip, and then you've got the previous peaks of the stock market. And so if I were to take a wild, what I call swagging it stands for scientific wild ass guess. So if we're going to swag it a little bit, let's add some bounces here. Remember that when the stock market made a double top, it crashed and then rallied up to the resistance of the little crash that was in the middle. We've had a number of little crashes in 2018. And so you've got to take this area of the crash before Jerome Powell introduced said that he was going to raise interest rates and cause the stock market to crash. And so somewhere in this area, I'm expecting for the first couple of weeks or months of 2018 that we're going to rally a little bit and come back up into this resistance area, but probably make a lower high. And then we'll have a crash that goes down to the 38.2% retracement and this support zone. And a lot of the media will be saying, hooray, the crash is over, time to get back into stocks, and it'll rally up until it encounters the resistance of the crash that we've already experienced. Remember, we've bounced off of this low already. So we're already on our way up in this rally that I'm predicting for the first couple of months. But once that's over, crash down to this 38.2% resistance, a rally back up to this now, and then another crash. Now, this support at 50% is sort of weak. There's not a whole lot, back over here. It's just this one little dip. So it might just blow right through that. I have no idea. But it may bounce off of that. If it does, it'll probably rally back up to this the support that will become resistance at that point. And then it'll be down to the 61.8 or 62% retracement just to round it off. But that's huge. 62% of all the gains made since March of 2009 into 2018 will be wiped out during this event. And you know what? I think that is one of the better scenarios. Now, it's possible that something could get announced where the stock markets rally and we do set new highs, but I think it is highly unlikely. This is one of the longest bull markets for the stock market on record, and it's old in the tooth. We created some tax cuts that have goosed the economy and pumped this a little longer than it should have gone. And those tax cuts were already factored in to the stock markets when they were passed early in 2018. So this little blow-off top that was happening here, this was the anticipation of the tax cuts. So I think that this is actually one of the better scenarios. But if we have a really bad recession or mini depression, I think that this is entirely a possibility. And the worst case scenario is this. This would be what would happen if we really go into a full-blown crisis / potentially depression because of all the manipulation that they did to this market. Now, I want to get into this, the gold-silver ratio. And the reason I bring this up again is that silver is, once again, an incredible bargain. This goes back 10 years, and it's a rare moment when you see silver 1/80th or less of gold's price. So it was at 1/30th when silver peaked at $48 back in 2011. And right now it's 1/82nd of gold's price. However, this also points out some pretty good places. The bull market in gold started in 2001, but buying in 2003 would have been a great entry point. And then when the stock markets crashed and gold and silver crashed harder than gold, and you could have bought gold or silver if you were paying attention to this ratio, and you got into precious metals right there. You could have bought gold under $1,000 or silver under $10 if you entered at that point using the gold-silver ratio as an indicator of when to get in. This was also a good entry point. The bottom for gold was in late 2015, December of 2015, and it was just coming off of that bottom, so an excellent entry point. And this might be pointing out that this is an excellent entry point again for precious metals. Now I'm going to go into a comparison of gold versus the mining stocks, and I'm going to use 3 different indexes. Now, I discovered a long time ago when I was writing my book, I divided the Barron's Gold Mining Index by the price of gold. And the Barron's Gold Mining Index, the reason I picked that one is it goes back many, many years. So I could go back to August 15th of 1971 when gold became freely traded. What I discovered is that over the long run, just the physical metals outperform the stocks. There are periods of time where the stocks way outperform the metals. But the thing is, they seem to outperform the metals. Like if you get a 4-to-1 leverage on the way up, you're going to get a 5-to-1 leverage on the way down. So over the long haul, so this is the gold mining index measured in the price of gold. So this isn't measured in dollars. And the bull market in gold started here and went up. And so for a year and a half, basically, the XAU, which is the Philadelphia Gold Index, it's an index of a bunch of gold producers. Most of them are hedged, where they sell futures contracts or forwards, and then they deliver into those futures contracts a year down the road or 2 years down the road. And so the price is locked in, and if the price rises, they don't get a chance to take advantage of that. The price is locked in before they dig it up out of the ground. So it outperformed. There was a year and a half here where during the beginning of this bull market, the XAU, that combination of precious metals mining stocks, did outperform gold. But on the whole, they've had some tragic losses. Now, you really can get some leverage here. This is the HUI. This is mostly unhedged and slightly smaller mining companies. There's a few companies that these 2 indexes have in common. But this HUI index has some silver producers and some producers, many producers that are unhedged. And what you see here is an enormous leverage against the price of gold, where it made huge gains. You're talking about probably 0.13 or 0.14 rising to 0.6 something here. And this is a ratio over the gains that gold was making during this time. However, from late 2003, that was it. It was over with. Now, I was lucky enough to buy some gold stocks and catch this final leg up, and I made some huge gains. I bought gold stocks in late 2002, and I bought silver stocks in 2003, and I caught that last up leg. And then I was lucky enough to do that study on the Barron's Gold Mining Index, and I sold all of them in this area. I think I held on to a few and went through this bounce and sold a few more in 2010. I can't actually remember right now. But on the whole, if you look at this, gold made great gains from 2008 to 2011, and yet it was outperforming the mining stocks. The mining stocks did not make those gains. And so if you're going to go after this leverage, I personally what I would do. I don't make any recommendations to anybody. I never tell anybody what they should do. But what I did was I subscribed to a bunch of gold newsletters. I followed a guy named Jim Paplava, Jay Taylor, and I really followed my friend David Morgan of the Morgan Report. So if you're going to take a look at any of the mining stocks, and they are undervalued right now, but you need to actually pick the best ones. And that's hard to do unless you've got somebody that's grinding through spreadsheets and looking at core samples and things like that, and can make a really good, a well-informed recommendation. And that is these precious metals mining newsletters that are out there. So take a look at those if you're interested. Personally, I just like sticking with gold and silver because they can't go bankrupt. They haven't gone bankrupt in 5,000 years. They're still around. Here's GDX divided by gold. This is the junior mining companies. And so they typically give much, much better leverage, but they're much more risky. And so this doesn't go back nearly as far. Each one of these, the XAU went back a lot further than the HUI went, and this starts back in 2006. But you can see, gold and silver put in their peaks in 2011. And the juniors weren't even doing as well as gold and silver back then, and they've way underperformed gold and silver all the way down right now. However, like I said, they're probably undervalued. But what we are looking for is we're looking for these indexes to start leading. We're looking for these to start rising. And when they start rising and outperforming gold, that means that the next leg of the precious metals bull market, the third leg, from 2001 to 2011, we had the first leg up, and then we had a cyclical correction inside this big secular bull market, the mid-cycle correction, which I think now is over with. And we're going to see gold and silver, especially silver, go to some amazing heights, but silver will probably lag. You may see that gold-silver ratio go up to 100, but that doesn't mean you shouldn't buy silver. I personally will be buying more silver if I see the gold-silver ratio at 100. Now, the rest of this is for the insiders, and so anybody watching this on YouTube, thank you very much for watching, and I wish you the best in 2019. Hopefully, it'll be a great year for you. And now for the insiders. As you all know, we've been following the Commitment of Traders reports for a while now, and there's some very unusual things that have been happening. And I just wanted to show you that for the insiders, I think that there's going to be